Hi, welcome to Silicon Dragon Talk Show. I'm Rebecca Fannin, the host of the show. Today we are interviewing two special guests, Tung from GGB Capital and Lily Wong from SVB Financial Group. So thank you very much for being here. We're going to be talking today about financing trends for Chinese and US startups and talking a little bit about Silicon Valley in China and also Sand Hill Road in China. So I'd like to ask you, do you think that there is a Sand Hill Road in China? And if so, where is it?
That's a question we get quite a bit. Like, is there Silicon Valley in China? Is there Sand Hill Road in China? If there is one, I think it's end up being in Beijing. Beijing is still where most of the tech startups, internet startups in China are being formed. Increasingly, Shanghai, Shenzhen, Hangzhou playing a key part, but to have to pick one, Beijing is probably the one with the most amount of money and the most amount of startups happening.
So why is that? Is that because it has a Stanford University nearby? It's got all the VCs setting up nearby the university to capture those graduate students?
Right. If you look at the US example, where MIT, where Stanford and Harvard are, it tends to be a lot of startups. Stanford in particular has done an amazing job. Obviously, I'm a Stanford alum, I'm going to be a little biased. But if you look at China, Tsinghua, Beida are the kind of university where they attract the top students. A lot of them, when they come out, go to Zhongguancun, you can just start doing business. And that's, for example, how JD, a $35 billion company, gets started in Zhongguancun, on the street of Zhongguancun. But before that, all the portals, with Sina, Sohu, all end up being in Beijing first, partially because the government's there. So you want to deal with Chinese government to get your VIE license, ICP license, get any kind of license to operate an internet business. It's important to have a presence there. So a combination of the right schools and then the government being there, so you need to work with them. And once you have successful examples, like a Baidu, like a Sina, and a Sohu do well, the people who end up being there and leave to do their own startup as a VP or director of those companies end up starting the companies, their next generation companies in Beijing as well. So that just start that positive cycle loop. We also see something happen to Hangzhou with Alibaba, in Shanghai with Ctrip, and then in Shenzhen with Tencent. So there are other places. So I would say these four are the biggest cities for innovations in China.
So it's developing a little bit like the US with Silicon Valley, and then you have Austin, and then you have Boston, and you have New York to a certain degree, and even LA coming up. And Lily, your perspective on where is the Sand Hill Road of China?
So I completely, just add on Hans' comment, I completely agree. I think that instead of having one Sand Hill or one Silicon Valley in the US, you will see a lot of different sub-Silicon Valley innovation ecosystem in China. And if you look at, the origin of the ecosystem here, it started with like PayPal, probably, they come out with a lot of people that building their own company start with, right? And just like Hans talked about, different big company that they exit and they cultivated a big group of the entrepreneur, they actually come out. And I think if you look at the ingredient of an ecosystem, or analyze it, the ecosystem here, you have free flow to capital. That are commercial driven, and also you have university that can build a big talent pool, and you also have a good ecosystem of the service provider there that are startup friendly. And China have all of that. And I was working for Silicon Valley Bank in China, helped to build ecosystems. Because we believe that to be able to succeed in one place, you have to be able to have the environment. We need to have the ecosystem to do well. Yeah, you can't just be a bank there, stand alone and do good jobs. So in 2004, we as Silicon Valley Bank actually brought a big group of the venture capital clients from Sand Hill. And so that was a great trip.
I remember that.
Yeah, that was a famous trip.
It was.
Yes.
And the same in India too, but the China one I think was even better known.
Exactly. Yeah, we'd like to talk about that story. So I remember that actually after that trip, some of our VC clients, they actually opened up the office in
the office.
Yes, in our office, and I thought that was a great story. So I think nowadays the investment and the VC market in China, it's much more, it's like 3.0, right? You see the local funds and you see GPs that actually from Sand Hill, but then you see a lot of the newer, a combination of East and West. It's just same as the entrepreneurs in landscape.
Right. So are you seeing more of a trend now toward the local Chinese VCs versus the international VCs? Because I know a lot of these Sand Hill Road players did move to China, did set up teams there, did set up offices there. Are we now seeing a movement toward more localized China VCs?
Oh, I think right after that trip, within the first next 3 years, you start to see a lot more local Chinese VCs raising money from US LPs. Whether it's Qiming, look at Zhen Fund, you look at Innovation Works.
Right.
There were a number of GSR, number of funds started in China.
Yeah.
If you look at the top rankings today in China, amongst the top VCs, I would say the localized VCs have done better than the Silicon Valley VCs setting up a Chinese funds. However, the notable exceptions, Sequoia has done a great job.
Sure.
Red Point, Matrix China, these three in particular have done great. So for someone like DCM and GGB, we have set up being both countries almost from day one. So the approach is different. So you see these three models, someone in both places from day one, someone that do affiliate funds, and then you have the localized funds. But in general, I think as a whole, you have more localized funds that are just dominating and doing very well in China.
And you have RMB, a lot more RMB funds now today too. Do you see that becoming the majority in China, for China financing, that they want to go to the RMB funds in order to have more leverage and go public in China? Are you seeing that as a factor for startups
I think
financing?
in selected categories like healthcare or gaming, areas where you could have high margins and in a very regulated sector, and where the government license become very important, then it's easier for RMB funds to deploy capital because entrepreneurs will want the ability to be able to list locally. But in categories like e-commerce, social networking, mobile apps that potentially go global, they still want US dollar investments. So you do see roughly a sort of, I would say a 60-40, 50-50 split between demand for US dollars and demand for RMB. So for funds that are managing both assets, it's critical to manage and keep both LPs happy. If you just do one versus the other, you are potentially at a disadvantage.
Right. Are you seeing other alternatives emerging for financing for startups beyond venture capital? I mean, now today you have angel investing, you've got crowdfunding. Are these other scenarios playing a part in startups' growth in China, and how?
Absolutely. I think that I think angel investing, it's something that actually I think it works really well for Chinese investment culture, because you will get a lot of individuals that are wealthy and has capital. And the lack of investment opportunities, it would drive the people that to look at the investment opportunities in equities. So we've seen the emerging trend of angel investment, and also I think China experiencing dynamic between policy and also the market demand. One of the things is that we hear the recurring theme about capital outflow control. And that is the government's act trying to take a control on China liquidity condition inside China. But also the market demands there, because the investment opportunity that are less there. So you will see a lot of the fund and companies and also individuals that are looking for products or investment opportunity abroad. So we experience this China capital outflow trend, right. And I think that is going to continue to grow, but much smarter. And you will hear, and also you will see them going through maybe more formal channel and also online channel as well. You see company like Futu and just like the Robinhood in China, they are helping that the Chinese individual access to foreign shares, and they will become the asset management company that for a lot of the wealthy entrepreneurs actually in China already have offshore wealth. So in terms of investment, the vehicles that we definitely see that VC still, from what we have learned, that has been the majority of the funding so far. And then I think angel investment is getting very active. Kickstarter and also some of the company are getting great names there.
Yeah.
So. Yeah,
I think in China you're seeing these serial entrepreneurs who are now angel investors. it's a little bit like the same thing in the U.S. It's happened in China too. So it is kind of interesting that so many parallels, U.S., China, in the way in the development of technology and in venture capital in both markets. So what do you see as kind of the major differences? If you're looking just at venture capital financing, what are some of the differentiators for Chinese startups getting money in China, or those who are going after China? There's a lot of U.S. startups that want China venture capital. I mean, what can they expect? What are the differentiators for them in looking at a Chinese venture capital source?
I think Chinese sources in general are much tougher on the terms. You look at the term sheet for Silicon Valley versus China. Here, you don't have redemption. You don't get redemption rights. In China, after 6 years, you have redemption rights up to 1.5x in preference. Here, it's usually, at least the last few years, you do see preferred protection with participation after the liquidation preference. After the 1x liquidation preference, the investors cannot get additional protection. You cannot share the upside. It's either take the 1x or you take the upside, but not both. In China, it's very common to have both. And as a result, you argue that here is extremely entrepreneur friendly over the last few years. But in China, I would say the localized VCs that have US dollar funds tend to be even more open and friendly than the RMB funds. The RMB funds are extremely aggressive. But what's the trade-off? The trade-off is that in China, decision-making happens at a much faster pace. And a lot more people are willing to bet early, and even where there's not very much. Here you see it too, but the decision just takes longer. Deals here, early deals, ends up being 10 people, 20 people, 30 people, 40 people get involved in. In China, 2 funds, 1 fund may just end up doing the early thing by themselves. So the willingness to take risk, I would argue, is higher in China than it is here by the individual funds. And the speed of the startups they move also move at a faster pace. Hugo has often, Xiaomi has often talked about 996, 9 a.m. to 9 p.m., 6 days a week. Over here, that would be, criminal because you have no work-life balance anymore. Right. That doesn't make any sense. But in China, in startup world, it's extremely common. Right. I know several U.S. entrepreneurs, after they sell the company here, end up going to China just to see what's it like, what's given all the hoopla. Right. And a lot of them are shocked and surprised how aggressive and fast the Chinese companies move. Yeah. Uber is already probably the fastest, one of the fastest, if not the fastest company here in the U.S. in terms of ability to innovate. But compared to Didi can operate even faster speed. So that willingness to that drive is incredible. It kind of reminds me of like Japan from 100 years ago. And that willingness to do more, to innovate, to create more is extremely impressive. How long is that sustainable? I don't know. I can't claim to be an expert to foretell that, but it is interesting, extremely interesting to watch.
Oh yeah.
I absolutely agree. I think in terms of in terms of deal making, China's speed, it's like everything else. It's like building, it's like construction. Everything else is so much faster. And also, we love doing venture debt. SVB. It's that's our what we know of, right? We believe. Actually, I think the ecosystem believe that in terms of capital formation, you have equity and you have debt. And that will give, it's the best for the entrepreneurs, right, in terms of in a bad time and good time. But I think in China, we still sometimes you will hear people have the resistance to debt. They believe debt is expensive. But here you will hear that a lot of entrepreneurs that they think debt is probably, it'll be helpful for their runway. So I think that's something that we continue to work on. In SVB, we form a joint venture bank with Pudong Development Bank in China, and we one of the first U.S. commercial bank that actually granted this license by CBRC in the last 15 years. So we are. We work on the ecosystem. We're also trying to help them understand the differences. I wouldn't say differences. We help them understand like the benefit of debt and having debt in and Hans knew this very well that he's been been very great work with his portfolio companies.
So that is a major cultural difference.
It is a huge difference because over here, more companies do take venture debt, like Lily pointed out. Yeah. In China, entrepreneurs tend to view that as potentially limiting to what they can do operationally, rightly or wrongly. And so it's easier to get our startups here, even Chinese startups coming here to take on venture debt. But in China, it takes a bit more work.
Right.
And the calculus that Chinese entrepreneurs do is that, sure, if I take more VC money, I may get dilute more. But at the same time, if I take the money and then there's no restriction, I can do whatever I want. I can grow a bigger company, and then the upside will be worth
Right.
versus
Right.
the dilution.
Right.
So there's different calculus that the Chinese entrepreneurs are doing in their heads.
That brought up a great point. I think that especially when Chinese companies are out here, when you work with foreign financial service company or banks, one of the things is that when you do take money, there are covenants, and you need to have the financial discipline that
Correct.
to employ it to operate in the market. So I think that's one thing that we talk with our customers and investors all the time. You can't really just take the money and do whatever we want.
And the Chinese entrepreneurs want to do that. Like Didi, you need to engage in a battle against Uber, boom, pouring in lots and lots of money. If they take down debt, it will be harder for them to do that.
Yeah.
So you can see it's a very different mentality that Chinese entrepreneurs have in China.
So Didi is one of these unicorn companies that has emerged from China, and there's a whole bunch of other
Yeah,
unicorn
yeah.
companies. And now we're starting to see a little bit of a slowdown in the market. Are we going to, and these huge valuations, are those going to be a thing of the past, or are these unicorns?
Things run
I
through
mean,
cycle, and you know this very well. Look at the companies that are becoming unicorns today, the last couple of years. They all got started in 2009, 2010. So that was the period when social networking became much more mainstream.
Yeah.
And then you see the sharing economy started to take off. And then the technology, AWS, that has enabled to back those kind of growth ends up becoming unicorns. And now it's sort of a law. Like, what's the next big thing? Is it frontier tech? Is it AR, VR, big data, and then drones and that kind of thing? Or is it something that needs to be more mainstream than that? And people are trying to figure that out. So the existing unicorn will continue to grow. Some of them may not be able to sustain themselves, but the best ones, whether it's the Airbnb, the Uber, the Didi of the world, I think will have a lot more room to grow because the sector they're in are really disrupting offline sectors. And in China, when I moved to China in 2005, e-commerce percentage of retail is less than 0.1%. Now, Alibaba was just a small company. When GGB invested in Alibaba in 2003, there was no Taobao. When Taobao just got started, valuation was like $170 million. And then fast forward to today, with e-commerce being 17% of retail in China. And with that kind of penetration rate, it's double the rate in the US. In the US, e-commerce percentage of retail is only 8%. I mean, I say only, but it's still impressive. So you can see that kind of disruption happening with retail. Now you're seeing the DD with transportation. More and more sectors need to be more efficient. Not just in China, but in other emerging markets. And mobile internet is going to play a huge role in that. And this is why Alibaba today, the valuation is worth $200 billion, from $170 million to $200 billion, over 1,000x in 12, 13 years. That happens not because the startups themselves are good, even though they are good.
Yeah, they're riding the wave.
It's not just the wave, because they're really, internet's generating value. It's making the user experience in retail, in transportation, in housing a lot better, a lot more efficient, a lot cheaper than it was before. And that's why they deserve to have that kind of growth.
So do you think that any of these unicorns are going to become unicorpses?
Some will, but that just happens. It's not
Just
natural.
happens?
Just happens.
Are any of them on the verge of that?
I don't think. I hope none in our portfolio. I'm not making any prediction, but I think that's a part of the creative
Natural
destruction
cycle?
process. That's not a cycle, which is totally fine. And the talent in those companies will end up going to others.
Is that going to happen more in China than in the U.S.?
No, definitely not. If anything, I think in China, the companies can sustain themselves for a longer period of time because the cost of labor and efficiency factor is higher. Yeah. I actually see more companies here willing to sell and just get out to do the next thing. Whereas in China, people really persevere and don't give up, keep on trying. They can fire everyone, keep themselves, and continue to go until they find the next product. But people's like, it doesn't work. Done. I can pocket my 10 million, move on to do something else. Yeah. So the willingness to sustain is actually stronger in China than it is here, surprisingly.
Yeah. Are we still seeing unicorns emerging?
I believe so. I think that,
sure.
Yes. I just on Hans' comment earlier, I think China is, a lot of people talk about a deep winter right now, right? Especially in China, some of the companies that going through some of the corrections. But I think China's market is huge enough and also, the company, the ability to correct and respond to the market are unbelievable. So I think that Chinese company have a lot of faith on that. And then secondly, I think Chinese economy is not like just whole thing. There's many sub-layers about that. And I think that the market is big enough to insulate some of the corrections. And much faster, I think, that than, US, which I think that the capital market are high, in many ways, more, it's more connected, right, in Chinese. But China, you will see the tech innovation markets, a layer that kind of insulated from the rest of it. And then you see the traditional economy trying to transition into the, right, exactly.
Yeah, it's really becoming a tech economy.
Yeah, e-commerce in China now is, the market size is bigger than it is in the US.
Absolutely.
Then on the famous 2004 Silicon Valley Sand Hill Road VC trip, most VC you pull back then wouldn't think that e-commerce would take off in China. You don't have PayPal, you don't have credit cards, there's no UPS, FedEx. How can e-commerce happen in China?
Yeah.
Yet 13 years later, it becomes much bigger.
Yeah.
So they're going to see more innovations like that happening in other offline sectors beyond just retail.
Yeah.
And that's very interesting. But even then, as big as e-commerce is, you look at the entire internet sector as a GDP in China, as a percentage of GDP, it's less than 5%.
Yeah.
So it's growing fast, but it's still a small chunk of overall GDP. Give that another 10 years, China will become very, very, very different.
So I think some of those initial curiosity seekers who came from Sand Hill Road, venture capital scene from the US to go over and explore China, even they today must be somewhat amazed at the progress.
A lot of people are very amazed. Very amazed.
In 1 decade.
In 1 decade. And
So what will the future hold?
If today internet as a category holds less than 5% GDP in China, imagine 10 years later, could it end up being 15, 20%? And what kind of impact does that make for Chinese economy as a whole to become even more efficient? Japan went through that growth cycle and stalled for 20 years because technology didn't make as much imprint on the rest of the economy as it could have been. China, a lot of people think China will end up being like Japan. That's a very popular school of thought in the US. But if the internet does well and makes an impact, could be a very different story. And I think India is watching this very carefully because it's a very interesting lesson for India as well.
This is definitely a continuing story. It gives us a lot more to talk about on future shows. Thank you for joining us today for Silicon Dragon Talk Show, and thank you, Hans, for being with us, and Lily for being with us, and we'll see you next time. Thanks again.
Thank
you.